I do want to talk about the idea of a shock. And you laid out three different potential shocks in your recent research, talking about the potential for upside acceleration in inflation. You say nobody's really counting on that, neither do you. Then you talk about some sort of liquidity shock. You talk about the Treasury auctions and some sort of issue with market functioning. And then you talk about what you see as the most likely, which you just flicked at, which is this idea of growth. Right. And that potentially you could see a real fall off in growth, which was kind of what we heard from Mary Daly. What are the signs that we're getting closer to that? And when do you sort of throw in the towel, and that being a near-term kind of reality, if we don't see more material weakening?
Well, the market is already leaning in that direction, right? It's saying that growth is probably going to disappoint. By the way, growth has disappointed this year. Most of the economic surprises have come on the downside. That continues to be the case, which is why that upside case is probably less likely. So how has the market dealt with that? Well, it's gone to large cap, quality growth and some defensiveness, which is very typical in a late cycle economy. The reason we bring this up is because look, the market's priced for a soft landing, and that is sort of the base case consensus view. That's all well and good. The problem with that is that let's say it happens, well, where's your there's a lot of upside, which means you got to pick stocks. And so that's what the market's doing. It's doing the best it can in that sort of a setup. So what's the key trigger going to be for us to say, okay, that growth is turning into a real growth scare or potentially recession fear? It's the labor market, right? The labor market, if the labor market breaks down, by the way, that's what the Fed's looking at too. So if we were to see a non-farm payroll number under 100,000, unemployment go to 4.3, 4.4, you better believe the Fed's going to probably cut rates. The market's probably not going to love that initially unless they cut 100. 25 basis points into a real growth slowdown, the market will correct probably 10% on that sort of an announcement.